Okay, let's move on to the third speaker then, before our break. Our next speaker is, if I pronounce this correctly, Jan Küthe. So Jan is an actuary from Germany, works at Accurate as an actuarial data scientist to help insurance companies unlock the potentials of 21st century pricing methods. Before that, he's been working at a global actuary consultancy for 3 years. He holds a master's degree in mathematics from the University of Bonn and is a mediocre but enthusiastic badminton player and an avid reader of the books of Dietmar Datz. So Jan, thank you very much. I'll pass it over to you.
Yeah, thank you very much for having me. If I may ask you, Shama, to stop sharing, sadly I can't share myself before the presentation is ended. And then I will very much enjoy to talk with you today about, sorry, here we go. I hope you can see my screen now.
Yes,
to talk with you about machine learning, and especially for you today, how we can apply modern machine learning techniques in markets that are highly regulated, where there are protection measures in place to ensure the stability of the institutes, but also the premium levels for our clients. Before we dive deeper into the machine learning, the modeling that comes with it, let's maybe first have a quick thought why it can be beneficial to move beyond advisory rates, or even if you want to keep those, to have a proper monitoring of your risk within your company. Many of you will have readily available this first block on the top left here, which is the amount of which is the premium a client is currently paying, which are the advisory, the compulsory rates. However, they are not necessarily based individually on your portfolio, on your clients, on the customers you have attracted as insurance company. And thus it can be very beneficial to also understand this very risk, to understand what your individual customers are doing. And especially it can be beneficial to do this exploration without too many constraints. Because if you do this, you can quite happily then understand the future portfolio performance. How profitable will I be in 1 year? Do I need to release some reserves in order to make a year's end? Also, you can use this enriched information about your customer base to maybe identify segments of growth. With those customers, I think I can help my company to grow in the future. Of course, also you can help out your company values and allow them to strive by providing this information, and then maybe increase the fairness of your tariff book. Lastly, let me then also mention that with us actuaries, building model and doing insightful analysis, that we of course don't do this for ourselves, but can let the whole company, all our colleagues, participate in this information as well, which could maybe mean that we help our underwriters to make even better decisions at point of sale when they set then maybe the final premiums in a commercial setting, or whatever it might be in your case. Okay, so with those in the back of our minds, those ideas and use cases, why you might want to move on and use machine learning techniques to understand your portfolio, let's talk about the major 2 points we as Actuary think are important when you want to enrich your arsenal of tools. That is the type of model, of algorithm, of approach you take, and very importantly, that you do this in a transparent manner. Especially, of course, in this use case here, with all the regulation that is in place. Okay. So let's maybe start with some basic charts for the beginning. Let's assume we are working in a private lines motor insurance portfolio, where you have features like the age of your driver here on the left-hand side of the screen. You also have vehicle information like the acceleration on the top right, or the claims information of your customers. So for each insured, you have those informations. And with this, you can do quite some things. Here, it's a first top-level analysis we show, where in the blue bars you do see the exposure distribution of your portfolio. Where, for example, when we look at the 38-year-old drivers, you have roughly 16,000 of those in your. Combined with that, we now show here in the reddish line the observed claims cost of your individual customers. So it's scaled by the mean, so that you see that the 18-year-old drivers you have in your portfolio are roughly 4.5 times more costly than the 30 to 40-year-old insured drivers. However, this information cannot be directly used when you want to take this past information and use this to make predictions about the future. We need a model framework to really identify what of those trends will be dominant in the future as well. And of course, we also need to account for correlations in our data set among our customers. You can see this especially here for the 90-something-year-old insured drivers we have, where there's very little exposure. You can scarcely see the blue bars that show you the exposure, which leads to very noisy observations that can be tough to use. Thus, we need this model framework I have mentioned. Yes. So what is it that we want to do? We have our customer information. We want to build a model extracting signal from that and bring this on to make predictions, to make statements about the future that help our underwriters to make those better decisions, to help our company to understand the profitability of their portfolio better. For this middle bit here, the approach, the model you choose, there in actuarial and general mathematics literature, there's a huge variety. Quite popular at the moment are, let's say, black box machine learning models. You could maybe think of gradient boosted machines, if you're familiar with those, for this example here, where you have some greedy algorithm that just takes every bit of information that might be lying around somewhere in to combine all this in be it weird looking trees or whatever, neural nets, all those things that are around, to then give you this one prediction for each customer at the very end. However, the problem is, and of course, specifically when you need to demonstrate the regulator that where those predictions come from. So maybe if client A is predicted to have a future claims cost of $200 US, whereas customer B is predicted to have only $150 of future claims cost. You can't really say where the difference come from? What is it that makes customer A more risky? Yeah, also you have there are some protected features, like for example, age times gender, and yeah, other examples. It is basically not possible to really pin down your model. And that's why it's important to use a different approach. We call them actuarial models here on a high level, where you really boil down the selection of features. For example, here, we really focus ourselves on the most relevant, most understandable features, the driver age, the number of claims from the last insurance period, and the vehicle acceleration, maybe the size of the motor is a link to that of your vehicle, the insureds. And use this information to obtain the prediction as a first step that gives you those transparent models I mentioned. We call this limitation, let's say, the parsimony of a model approach. But we think you should also then combine this with a auditability of the individual effects. So, for example, here, this could mean that to each age value you associate one relativity that you then can multiply out. So that for each for me, I'm 30 years old, you get a relativity. I haven't had a claim previously, and I have a mid-sized vehicle, so that you can easily compute the prediction for me if I am your client, and thus also understand why I might be more risky or less risky than other customers. So this combination of a parsimony in the number of effects you model and the traceability of the individual effects then are important when you want to build complex actuarial models. And the very nice thing is that it is possible to fully automate this approach, as we will see in a minute. And this then really makes it machine learning to select those features, to select the parsimony limit you want to use, empowered by machine learning, to suggest sensible models to you as the actuary, so that you can understand, compare, and challenge everything. Okay, so this is the high-level idea. Let's maybe compare this quickly to the theoretical background. Many of you might be familiar with a quite standard approach of linear models, linear regressions, where you have one dependent, one independent variable typically, and fit a linear trend among those. This is a very well known technique, and can be applied in many fields. However, in insurance applications, you typically don't have this nice linearity, but highly non-linear dependencies, as you can see here on the right-hand side, where the risk associated to, for example, this feature here, the driver age, does not really behave in a linear way. And thus the model class of generalized additive model, generalization of the generalized linear models, which are as well a generalization of the linear models on the left-hand side here, do fall nicely into place for those applications. Because you have a very nice setting that fulfills all those what we desire from our actuarial models we've discussed before. If you put it into a formula, it can look like this. You have some link function g, typically the logarithm. You have your client information. We call them xd here for the independent variables. And then you have a summation over the effects you want to use. How does this look? Each of those betas is a function in one customer detail. So for example, one curve in the driver age, one curve in the speed of the vehicle. And like this, you can do it for all client features, respectively, all client features that you want to use in your model, that you want to use to make those predictions about your customers. And yeah, when automatically fitting using machine learning techniques, those powerful but still transparent auditable models, you can obtain yeah, quite the information from your customer base. Yes. Okay, so let's now maybe discuss what you can do when you deploy those models in a nice automated setting. And for this, let's maybe start to have a look at a curve like this, which might represent some advisory rates you are working with currently, where you have some grouping of the age of the driver from 18 to 20, 20 to 30, 30 to 40, 30 to 50 years old, and so on, and have associated one relativity for those clusters. For example, indicating that the very young drivers should get the maximal relativity that would be admissible here with a surcharge of those 300%. This is a model that makes sense, that is well proven by basically data from all over the country. However, we've discussed that for your individual situation, it might be a little bit different. So let's fit a unconstrained model where you don't limit yourselves to those age groups. For example, you don't apply the maximum constraint of 300 percentage points, which could give you curves like this, where you would want to add 550 percentage points and for the very young drivers, but still for the lower 20-ish-year-old drivers, you would also want to put considerate surcharges in place. Okay, what do you do with this? We've discussed adjusting your reporting, your internal reporting. However, you can also use this to change your tariff. For example, if you are currently using the advisory rates as tariff, you can identify segments where you might want to increase by 12.5 percentages, and thus increase the 20 to 25-year-old drivers by those 12 percentage points, give them a surcharge of 200%, which is indicated by your portfolio, and if you consider this appropriate, can help your profitability. And the very nice thing by using those generalized additive models is that you can do this not only for just the driver age, but you might also want to change it for the experience of the drivers, for the years your clients have had no claims, and so on and so on. For example, here we gave a surcharge of 10 percentage points for the inexperienced and a decrease. Should I check? Okay, so and a decrease of 5% for the experienced drivers. Some other changes here, which are all indicated by the data. And yeah, this is all understandable. You can understand everything of this and take those informed decisions. But of course, you then can also move on and apply those individual cappings again to really make sure that no one individually is priced differently, and so on and so on. Everything possible due to this automatically fitted transparent model class. So that in the very end, if we, for example, here look at the expected profit we can make from our customers, you can really adjust report on this to the extent that you and your company consider fair and well. Yeah, I also generated a double lift to compare the appropriateness from a purely statistical standpoint. All those tools can be at your disposal when you decide to move beyond maybe the advisory rates, when you want to see what is really going on in your book. So let me summarize what I've mentioned. We would propose to, or we want to answer our initial questions on how to use machine learning in a highly regulated market by a three-step approach, where you have your data, the information about your customers. You have a algorithm, a transparent setup you want to use, and of course the regulatory constraints and guidelines accompanying your company values. You of course also want to reflect in your tariff. Then fitting those generalized additive models, you can use all the machine learning cloud infrastructure can offer to fit nice and well, be it totally unconstrained or partly constrained models, or even models that could then be directly used in the Japanese market. But on top of this, due to the nice structure of the generalized additive models, you can use your actuarial expertise, that is from a field expertise view on things, to then adapt and change the model suggested to you. And you of course also can do this to further help your company values, to further help the regulatory guidelines to shine, and thus help out your company strategy, to then use all this work done to help your underwriters, to help the reporting colleagues in your company, to help the growth of the company you are working on with this machine learning empowered understanding of the individual situation of your clients and the company. Thank you.
Jan, thank you very much for your presentation. So we've got about 5 minutes left, so perhaps we can share a couple of questions from the participants. So the first question here I should put in the chat box. So as you presented, the machine learning model may be quite black box. Even with the actuarial model approach, how to debug or how to audit, or I suppose validate the model. Do you have any comments on validation of such models?
Yes, because once you are able to fit those models in an automated manner, as I mentioned, there's no reason to let the machine do this only once, but you can of course use cross-validation to fit several models and compare the differences to challenge them, let's say, and other techniques like holdout data. Maybe you leave 20% of the information you have aside to do a final check at the very end. Or then, of course, once you put it into production, you can use the new business, the last 2 months you incurred while doing the work, to use this as well to check. So yeah, with this transparency, you can check all the effects suggested by the models or adapted by you back and forth to really make no error.
Okay, great suggestions. Thank you. One other question that came through, I think the participant has heard that the US, in the US, the actuarial standard of practice is perhaps being refined to instruct the usage of new technologies such as machine learning and AI. Are you aware of any sort of similar changes in other jurisdictions, or perhaps any comments on regulation around the world or any specific markets? Thank you.
Yes, so for example, if you look to the United Kingdom, there the regulator is quite active as well and takes steps to protect customers from pricing methods that might not be considered too fair, where you did see quite significant differences in price between new customers and existing customers, where the regulator says, okay, it's not risk driven, it's not fair to give them different prices. That's just optimizing returns for the insurance company, which is of course is a fair point. And then comes back to the model, the transparency you take, because if you understand your model, however the setting changes, you can change your model with those different constraints put in place.
Okay, thank you very much. Okay, one final question has come through. From your experience, will the result produced by the machine learning be much different from the traditional method? Perhaps you can maybe comment on some effects or benefits that may come through in machine learning. Thank you.
That's a very good question. Thanks a lot, because there really is there need not be a conflict. We want to extract information, and thus it would not be very beneficial to leave aside the information we already have. So, for example, something you could do is to take the current, or as you call it, existing model, and use this as starting point to let the automatic machine learning model then not start from scratch, but see, okay, at this part we want to maybe change slightly, here we want to get slightly lower. Really, it's good to combine those two worlds together to benefit from each other. Okay, great. Thank you very much, Jan. So those are all the questions we have. I'm sorry. It looks like one final question came in. I think we have a few minutes for it. Let's see. Give me 1 second, please. Okay, this is on operational capacity for implementation of machine learning. So, do you observe any constraints for companies to implement machine learning? For example, computing capacity, and what are the practices of companies to overcome such constraints? Thank you. Yes. So this, of course, depends on the way you structure it. We at Actuary offer a hosted cloud solution for this, so that there would be no problem in scaling the complexity. But overall, with all the development going on all over the world, the computation power has quietly risen, so that from our experience, it does work out quite nicely. Either to use partners, you can do this with, or to scale your individual cloud computation powers. Yeah, I don't know if I can go much beyond of an answer, but yeah, maybe one last sentence that the nice thing about the GAM model is that the final model does not look different from what you might be doing currently, where you have like 10 lookups of values. So it's a very small table-based format still, which is quite different than maybe from putting neural networks or tree-based models into production.
Okay, very good, Jan. Thank you very much. So that's all we have for our questions. We're just about out of time. So I want to thank you again for your very informative presentation. I really enjoyed it. So thanks again.
Thank you very much, and have a great rest of the day with your presentations. Bye.
Thank you very much. Okay, so it's now 4:10, so that brings an end to our current set of 3 sessions. We're going to take a break now, and we're going to come back for the next set of sessions from 4:30. There'll be a different link into that session, so please log out of this link and enter into the next link before 4:30, and then we'll see you there. So thank you very much.